who's your lender? And they say, well, it's this dentist in Hartford. Scale is about speed. It's about you being able to execute your strategy without the friction of a lender standing in your way, whether it be your inability to show an income or maybe you have too many assets, your debt to income ratio is off. We don't care about any of that. We're simplistic, we're common sense underwriting, we're common sense lending. And to me, that's as close as I can get to the ownership side, which I tend to love. I would be in this room listening to me if I were you guys, because I love flipping. The first house I ever bought was 25 years ago. I flipped it in 5 days and made 110,000 on a flip like that. There's so much money to be made in this business. Finding off-market deals is the key right now, but it's a really, I love it. I love it because it's fast. And again, it's the purest form of lending. In Wall Street, what happened is it took a while, but it's the oldest form of lending. But after the financial crisis, it starts to become more formalized, right? You start to get bigger private equity groups involved, and they see the opportunity and they have the capital to say, don't go to the bank. Banks can lend deposits, and you know how much money you make with your money in the deposits. You're not making anything. Banks are lending it out at whatever, 5 or 6%. They're keeping that delta, and that's cheap capital. But with rates in the private money space, in the private lending space being where they are, it allows private equity to return a certain yield to their investors, which is pretty attractive. And so they start to formalize what that looks like, and they start to get it recognized in the secondary markets, and it starts to become a real viable lending program. And it's called residential transition lending. It's RTL, and it's definitely something that is massive. It's not what you read about. A lot of the private lending stories that you're reading about right now has to do with these shops, private equity shops that are lending into the AI bubble. They're lending crazy amounts of capital for all sorts of different things that I won't get into. We're more, we're secured by real estate. We have borrowers that have cash flowing properties. But at the end of the day, why I love this business is that when I was out buying properties in Connecticut and I'm competing and I say, who's your lender? And they say, well, it's this dentist in Hartford. I'm like, well, what do you mean it's a dentist in Hartford? How are you getting money? It's $1 million property, whatever. So, well, the dentist, I think, has about 20 million on the street. And you're like, whoa, private money guy, dentist, really lender, has 20 million of his own money on the street. You have lawyers, doctors do the same thing. They pool their money together. I was talking to Mike about a private money guy that he knows that when you build up a level of trust, that private money, that old school way of hard money lending really is invaluable because they can know you better than anybody. But to get to that cheaper cost of capital where lenders like us play, where you start to get more experience, you start to look to get scale, you start to come to shops that offer a little bit more expensive capital than banks, but with the speed that banks can't even touch. And when you look at that and you say to yourself, I'm gonna go out and buy a property tomorrow and it's a foreclosure, but I gotta close in 2 to 3 weeks, bank, deal's dead. Cash, a little bit down payment and you're able to get it done. And we're able to close it in 2 weeks all day long. I've closed a deal in 3 days. Back to regional small country club lenders was the old way. We talk about why hard money. We've talked about it. Speed. Loans are approved in my shop and in a lot of the shops in hours. And we're closing in 2 weeks or less. We're using local providers that know the markets. Local attorney, local appraiser, local inspectors. And inspectors, I mean construction inspectors, which is a different element to our loans. We're funding purchase of the property plus construction and sometimes also interest. So we want to make sure that we're inspecting the property, and we'll talk about it actually in the construction side. So pros use me like cash. I have countless borrowers from Candor. I probably have funded over 125 deals with Candor investors. I have a group of 4 or 5 that I've done 82 loans with on their own. So they're bankable all day long. In fact, I'll take half. We just did a deal in Maine where I took a piece of a big portfolio of properties. I took the piece that needed the rehab, and they used mine for the rehab properties, and they used the bank for the more stabilized properties. So, there's reasons to use us, and there's reasons to not. But interest rates, and when people talk to me about interest rates, which range, by the way, with us, 9.5% to 12, right? So 12. Whoa, what do we? 12. It's crazy. Why would I ever borrow at 12%? My first loan was 12%, 2 points at origination, 2 points on repayment. So that was 16% was my first loan in the space. The borrowers don't care because a 12% rate when they're out for 3 months is 3 points of interest. And oh, by the way, they were able to close it in 2 weeks and they didn't have to deal with the bank proctology exam. They're able to move at the speed of the deal versus at whatever the bank allows. Speed of money. You don't want to use our money if you're going to do a deal that's a development deal. Let's say you're doing an approved project, but you still got to go through design or permitting, whatever it needs. It's going to take 9 months. And then you're going to start building, and then it's going to take another 6 months to sell out, whatever. You don't want to be in our money because it's too high of a rate to be out that long. It'll destroy your returns. So there's a place for us, and it's usually, there's a speed. Your model will dictate where the breaking point is. I like to think a flip should be evaluated within inside of 8 months. Otherwise, it's not really going to work. So, that's kind of how I look at it. Flexible. So when we talk about flexible, we mean like, we're not looking at your debt to income ratios, your income at all. We're not asking for tax returns where we do a soft credit pull and a background check. We are looking at your experience. The hard part with us is to say, how many deals have you done in the last 3 years? We're going to verify that. And most lenders have moved in this private lending space towards that model. It's trust. We'll talk about deals. We'll talk. I'll get you a quote. We'll get ready to go, and then we'll get the loan approved, and then we'll verify. And the way of verifying you and qualifying you as a borrower is through experience, right? So, on-title experience. You own an LLC. That LLC owned a property. We'll go on record, say, yep, they own that LLC and they own that property. That's one. One will get you a certain rate in leverage. 5 will get you the best rate in leverage, and anywhere in between is a risk tolerance. We might give you, we might fund 85% of the purchase price for somebody that's a 1 to 3 experience, but 3 to 5 plus, you might get 90% of the purchase plus construction plus interest. So experience drives the bus, not your debt to income ratios, how much money you made, none of that. The other good news is we don't report to credit agencies. So a lot of the times my borrowers are using us. They're builders, contractors, their Home Depot cards are going like this and like that. Their credit scores are also going up and down. We only do a soft pull. We don't report to credit agencies, and we don't care about your credit so much as it just needs to meet a certain minimum. That's it. So if you're experienced, it's 660. And I just got a guy approved at a 610. But as long as it doesn't show anything that stands out that says you're a bad borrower, well then, they're going to get over it and they're going to defer to your experience and approve the loan. Construction specialists, that's really what I think we do best, right? Because banks don't do anything fast. They especially don't like high-touch construction loans. High-touch construction loans means you're going to get the money at close to buy the property, but then you're going to need the money left over for construction that's in escrow to fund out the rehab, to fund the fix and flip, to ultimately get to that after repair value. So at the end of the day, you want a lender that can get through the closing fast, but you also need them to get through the draws equally as fast, because that's getting your money when you need it to replenish your liquidity to keep your project moving and do a close.